Welcome to The Explainer. Today, we're pulling back the curtain on a massive, under-the-radar risk that honestly could change the way you look at investing forever. And forget everything you heard about 2022 being the end of an era. The real reckoning, it's just around the corner.
Okay, let's really dig into this quote, because this one single idea reframes the entire market we're living in. For more than a decade, companies loaded up on debt at unbelievably low interest rates. But here's the thing about debt. It always has an expiration date. And when these bonds come due, the world they were born in is going to look like ancient history.
You know why? Because the answer isn't sitting in the stock price you see on your screen. No, it's hidden, buried deep inside a company's balance sheet, where a quiet crisis is starting to brew. A lot of companies that look like a bargain on the surface might be fundamentally broken underneath, and we're about to show you exactly why.
So how in the world do we get here? Well, this story starts big. I mean, on a massive economy-wide scale. This isn't just about one or two companies making bad decisions. This is a systemic issue that's been baked into the market for over a decade, and believe me, it affects pretty much everyone.
For years and years, policies with these acronyms, ZIRP and QE, basically just flooded the entire system with easy credit. The central banks, well, they made money artificially cheap, and that sent a crystal clear signal to corporate America. Borrow, borrow, borrow. And boy, did they listen. They took on record levels of debt to do everything from expanding their business to buying back their own stock.
Now this is where it gets really interesting, because the contrast is just so stark. We've gone from a world where borrowing at 2% was totally normal to a reality where even the super safe 10-year treasury yield is over 4.5%. Look, this isn't some tiny adjustment. It's a fundamental tectonic shift in the cost of capital. You could say the party is officially over and the bill is finally coming due.
Okay, take a look at that number. It's staggering, right? And what's crazy is that it's only part of the story. This is just the commercial real estate piece of the debt pie that's coming due by 2026. This sector is what you'd call the canary in the coal mine. It's super sensitive to interest rates, and it's also getting hammered by stuff like the work-from-home trend. We're talking about massive loans that were written in a completely different financial universe, a universe with near zero rates. And now, all of them have to be refinanced in today's high-rate world.
And this chart just illustrates the problem perfectly. See, it's not a gentle slope we're climbing, it's a wall. Just look at that massive spike in debt that has to be refinanced in 2026 and 2027. This is what all the analysts are calling the maturity wall, and a whole lot of companies are about to run straight into it full speed.
So what does this huge macro-level wall of debt actually mean for individual companies and, more importantly, for your investments? This is where the risk stops being theoretical and starts getting very, very personal.
This right here is the direct consequence, the rise of what we call zombie companies. Think about it. These are businesses that are just profitable enough to pay the interest on their old, cheap debt. But the second they have to refinance at today's higher rates, poof, their profits get completely eaten up by those new interest payments. They can't grow, they can't innovate, they can't invest. All they can do is survive.
Just look at this. This is the brutal, simple math of the situation. We've got the exact same company, right? Same operations, same $10 million in operating profit. The only thing that changes is the interest rate on its debt. And a simple refinancing, something totally out of its control, wipes out nearly half of its net profit. The business itself didn't get any worse, but its entire financial foundation just crumbled underneath it.
Okay, now for the most important part. How can you, personally, spot these fragile, zombie-like companies before they blow up in your portfolio? It's time to stop looking at the stock price and start acting like a financial detective.
Here it is, a simple, 4-step financial health checkup that anyone can do. Think of these as a company's vital signs. They tell you if it's strong and healthy or secretly fragile. We're going to check its leverage, see if it can actually afford its bills, and check its short-term survival odds. You know, these are the individual building blocks that the pros use. Sometimes they combine them into fancy bankruptcy prediction models like the famous Altman Z-score. But once you understand these core parts, you can build that picture for yourself. So let's break them down.
First up, debt to equity. This gives you a really quick snapshot of how much a company is leaning on borrowed money versus its own funds. Picture a seesaw. On one side, you have the company's own money, its equity. On the other, you have all the money it borrowed, its debt. A high number here means the debt side is way down, making the company super leveraged and really vulnerable. A good rule of thumb, anything below 0.5 is a fantastic sign. It just means the company is funded more by its owners than its lenders, giving it a really solid foundation.
Now this ratio, this is the ultimate zombie detector. It directly answers the most important question. Can the company actually afford its interest payments? A healthy company wants a huge buffer here. A ratio of 3, 5, even 10 times over means their profits are just dwarfing their interest bill. But a zombie company, it's living right on the edge with a ratio near 1.0. If you see a number below 1.5, that is a major, major red flag. It means there's almost no room for error. One bad quarter, one surprise expense, and that could be all it takes to push them right over the edge.
And finally, we have the current ratio. This is the company's short-term survival metric. It answers a simple question. If the company had to pay all its bills due in the next year, could it do it with the assets it can quickly turn into cash? You really want to see a number above 1.5 and ideally above 2.0. This 2-to-1 benchmark has been a classic sign of financial safety for decades because it means the company has $2 of liquid assets for every $1 of short-term debt. That's a strong buffer.
This table right here is your cheat sheet. On the left, you've got the signs of a financially strong, healthy company. On the right, all the warning signs of a potential zombie. Now think back to our example company from a few minutes ago. Before refinancing, its interest coverage ratio was a super healthy 10x, firmly on the left side of this chart. But after refinancing at the higher rate, that same exact ratio plummets down to just 2x. It's not quite a zombie yet, but it is dangerously close to that 1.5x red flag. Its resilience is just a fraction of what it used to be.
All right, let's move to our final section and see how all of this comes together to completely change how we should be approaching investing in this new environment.
So, to sum it all up, the game has fundamentally changed. That old strategy of just buying the dip on a popular stock is now incredibly risky because that dip in the stock price might not be reflecting the full-blown crisis happening on the balance sheet. The consequences of a decade of free money are here, and they're creating fragile companies that simply can't handle higher interest rates. This means digging into a balance sheet is no longer just for the pros. It's now a basic survival skill for every single serious investor.
And that brings us to the final and most crucial question of all. It's the one I'm leaving you with. It's time to look past the headlines, open up those financial statements, and apply this new lens to your own strategy. Because in this post-cheap money world, a strong balance sheet isn't just a nice to have, it's a matter of survival.